It is now my pleasure to introduce the two speakers, Wen Lee, CreditSights Senior Analyst for Metals and Mining, and Charles Johnston, CreditSights Senior Analyst for Coal Producers and Canadian Pipelines.
Good morning, everyone. My name is Wen Lee, and I cover the metals and mining sector here at CreditSights. I have Chaz Johnston here as well, and he covers the pure play coal names in the U.S. Chaz and I would like to welcome you to the metals and mining presentation. As you may recall, CreditSights hosted a metals and mining webinar last year in February 2014. And since that time, and over the last 16 months, we've seen a dramatic decline in commodity prices. Iron ore, met coal, and steel prices dropped pretty dramatically. And in the last presentation, we focused on crossover names. And as you know, CLIS went from IG down to high U, down to distress in a matter of months. For Alcoa, it crossed over to high U, but could potentially move back to investment grade over the next 6 to 12 months, with Moody's, Fitch upgrading Alcoa's outlook to positive in April 2015. There's been a huge amount of volatility in the space in terms of commodity price movements and in terms of spread movements. We figure it would be very interesting to revisit some of the major themes in the sector and take a look at potential investment opportunities given the volatility in the space. So in this presentation, we'll take a look at some high yield distressed names and some recent issuance by these companies like Cliffs Natural Resources, Fortescue, and Peabody. We'll take a look at a potential inflection point in steel prices in the second half of this year and impact on steel credits like AK Steel, US Steel, and ArcelorMittal. We'll also take a look at potential crossover names in the last section of this presentation and look at their attractive levels, attractive trading levels at Freeport, McMoran, and Vale. Turning to the next two slides on page 3. We'll quickly go over some high-level overview of the sector. Obviously, metals mining driven by supply and demand. On the demand side, China accounts for roughly 40 to 60% of total demand for pretty much every product that's out there. Demand growth in China slowed down quite a bit. The expectation is GDP growth is going to slow down 7%, down from 7.4% last year and down from 8 to 10% over the past 3-4 years. And on the supply side, we're seeing a dramatic increase in iron ore capacity and to a certain extent copper as well. And in steel, aluminum, and coal, we're seeing excess capacity in that market. So there lies the problem. Demand growth is slowing down, and supply is increasing at a rapid pace over the next few years. So we're seeing a big dramatic decline in commodity prices over the past 3 or 4 years. Moving quickly to the next page, on page 4, you see that obviously fixed asset investments, construction activity has slowed down quite a bit. And home sales volume prices have slowed down as well over the past 3 or 4 years, and that's having a dramatic impact on commodity consumption and commodity prices as well. Now let's move to the heart of this presentation on page 5. I'll start with iron ore and Fortescue, and then we'll take a look at the domestic iron ore market and Cliffs Natural Resources. The seaborne iron ore market, we're seeing iron ore prices decline from $135 per ton early last year down to as low as $47 per ton in April. It's rebounded back up to the 60s right now. There's two things that's going on that's driving the rebound right now. There's one, the prospects of big caps are reducing capacity growth. You have BHP that came out recently that said that they're going to defer one of their projects. You have Vale on the first quarter earnings call saying that they may reduce 30 million tons of high cost capacity, or it's close down 30 million tons of high cost capacity in the south and southeast regions if needed. Those two announcements in themselves don't really move the needle by much, but that said, that's positive signaling from the big cap guys about potentially reducing capacity if needed. And another thing is that inventory levels at the Chinese ports have come down 30% in the middle of last year. So those two factors have driven prices back up to the 60s. But if you look at sort of longer-term fundamentals for iron ore, it's really, really bad. On the demand side, obviously demand growth has slowed down quite a bit. You look at China accounts for roughly 2/3 of seaborne demand, iron ore demand. And obviously iron ore goes in steel production. And steel production in China have slowed down quite a bit, so production growth at least in 2014. And expectations that in 2015, it's going to flatline or decline from here. And then if you look at the next page, on page 6, you see that all the big cap guys have expanded capacity pretty significantly over the past 3 or 4 years, with growth increasing roughly 9, 10, 11% on a per annum basis over the past 3 years. And over the next 3 to 4 years, they're projected to expand capacity pretty rapidly as well. The big culprit is Vale. Vale is working on that S11D project. Roughly, it's going to ramp up to roughly 90 million tons at a cash cost of $11 per ton. So Vale is going to move up to roughly 460 million tons over the next few years. Rio Tinto is going to move up to 370 million tons. BHP is going to ramp up to 270, 290. And Anglo American is working on their iron ore project, ramping up their iron ore project in Brazil, and that's going to ramp up to 75, 80 million tons over the next 2 years. The issue is that the cash costs for these guys are very, very low, and obviously oil prices and currencies have really moved down the cost curve. So these cash costs for these guys like Vale, BHP, and Rio are roughly $20 per ton or lower. And if you add in like operating overhead plus capex on a per ton basis, you're looking at a all-in sustaining cash cost of roughly in the mid-30s. So there's a lot of room to move down with iron ore prices in the 60s right now. So our expectations for iron ore prices to decline from here in the second half of this year. And now let's take a look at Fortescue. Fortescue is a pure play seaborne iron ore producer with a significantly levered balance sheet. Keep in mind they expanded from roughly 55 million tons to 155 million tons over the past few years, and they used debt to finance that roughly 9 to 10 million capex project. Very levered to iron ore prices, obviously, and you can see that leverage moves up very quickly as iron prices drop. You look at fiscal 2014 when iron prices realized prices at 100, their leverage is 1.4. They move up to roughly 9 times. If benchmark prices move down to $55 per ton. They came to the market recently. They issued $2.3 billion of secured debt. Timing was very poor, but if you look at the bigger picture, obviously they were able to issue secured debt before the window of opportunity closed. They were able to refinance their near-dated maturities, the 17 to 18s, part of the 19s, and they were able to kick the can down the road. So the nearest maturity is going to be in 2019. They have $1 billion on secured paper due. They have roughly $5 billion term loan B due. And obviously, they've done a very good job in terms of cutting costs. Their C1 cash cost is expected to come down to $18 per metric ton, down from $34 in fiscal 14 and down from $28 per ton in fiscal 2015. And their all-in sustaining cost is going to come down to a $39 per dry metric ton basis. So if iron ore prices drop to 40s, even 40, they'll be still making $1 on a per ton basis in terms of free cash flow. Now, obviously, there's a lot of things that they can't control in terms of production costs, oil prices, the currency. So if oil prices or the currency move against them, the cash costs will move up as well. And there's been a rumor out the past couple of months that the Chinese-linked companies may look to buy an equity stake in the iron ore assets. And we believe that could be very realistic, considering that the Chinese want to keep iron ore prices low, and they've helped, obviously, they pumped some liquidity into Vale buying their ships, and Vale got a $4 billion credit line from one of the Chinese banks. And the Chinese government has also subsidized some of the high-cost iron ore producers in China as well. So by keeping iron ore prices low, they're indirectly subsidizing the steel industry, which is a very important industry for the Chinese. So all in all, obviously, Fortescue is very linked to iron ore prices. Their cash cost position is fairly low right now, and they'll be still printing free cash flow, assuming that they can get their cash cost down to those levels. We like the first liens, but we will wait for better entry points, as we believe that iron ore prices will drop from here. Now let's quickly turn to page 8 and talk about the domestic iron ore market. A very, very different market from the seaborne market. It's a very isolated market with significant barriers to entry for foreign miners, given that there's a lot of transportation costs. For Vale to ship products into the Great Lakes, they have to go up the Atlantic, go through the St. Lawrence Seaway, and then into the Great Lakes area. And the cost would be very prohibitive. And so you have Cliffs, right? Cliffs, the biggest producer out there in the United States. It's roughly 50 to 55 million ton market in the U.S. Cliffs produces roughly 20 million tons. The competition is really the captive iron ore miners. Like U.S. Steel is fully back integrated into iron ore. ArcelorMittal and AK Steel have some iron ore production as well. there's been some new entrants into the market, like Magnetation, which is AK Steel joint venture. They filed for bankruptcy recently. That said, and unfortunately for Cliffs, they got DIP financing. We'll restructure their balance sheet and we'll come back and operate at 3 million tons. SR Steel Minnesota got financing in the fourth quarter of last year, but on a positive note, they came out and said that they'll push back their start date from the end of this year to the middle of next year. So that's a positive sign, given that Cliffs Natural Resources contracts they're currently negotiating contracts with ArcelorMittal at this point in time. Look at sort of the demand base, right? It's been a shrinking customer base for these guys. It's been a huge amount of consolidation in the market over the last few years. The latest one being AK Steel's acquisition of Sarasota Blast Furnace in Dearborn, Michigan. So there's essentially 3 customers with Cliffs right now: ArcelorMittal, the biggest one, SR Steel Algoma, and then AK Steel. And the mini mills, electric arc furnace, have taken a significant amount of market share from the blast furnaces over the last 5 to 10 years. Now they account for roughly 60% of the market. One positive note is that DRI could be a big drive for iron ore in the longer term. There's been a lot of talks, especially in the steel conference last week that I attended. There's been a lot of talks from the mini mills, from even Cliffs, about potentially building DRI plants over the next 3 to 4 years. But in the near term, Nucor actually mentioned in a steel conference that they're in talks about potentially sourcing pellets from Cliffs for that 2.5 million ton DRI plant down in Louisiana. At this point in time, they're sourcing DRI grade pellets from Brazil, Canada, Sweden. And if Nucor and Cliffs can finalize a contract, that would be a credit positive for the Cliffs story in the near term. Obviously, the big issue with Cliffs is their contracts. They have long-term contracts in place with the customer base that provides downside protection. The issue is that ArcelorMittal, the biggest customer, they account for roughly 50% of volumes, 40% of sales revenues in 2014. Those contracts are expiring at the end of 2016, at the beginning of 2017. Turning page 9. So that's really the big uncertainty for Cliffs, those contracts. Very binary. Get it done, they'll be able to survive the downturn. If they don't get it done, they will have to file for bankruptcy. We were in Chicago earlier this week, and we met with a bunch of clients, and one of the clients actually talked to ArcelorMittal's CFO, and the CFO mentioned that they will likely resolve this contract negotiation with ArcelorMittal, given that there's no viable other options on the table at this point in time. So that's a positive, but still a lot of risks involved. In the Cliffs capital structure, we like the first liens. We also like the 2018s as well. If you look at the first liens, it has a significant amount of asset coverage. On an LTM basis, LTM EBITDA basis, 605 million. And the first leverage down to the first lien level is 0.8 times. And even if EBITDA drops down to $200 million in 2017, their leverage goes up to roughly 2.7 times. Keep in mind that there's no additional, Cliffs does not have additional capacity to issue additional first lien debt. And so, on the first lien basis, they have strong asset coverage, even if they're unable to resolve that ArcelorMittal contract. For the 2018s, they're obviously a little bit riskier, the unsecured paper. But we think that they'll continue to chip away at those 2018s over the next 2 years. They'll generate free cash flow in 2015 and 2016, given the downside protection in those contracts. They're in the middle of selling the remaining coal assets as well. So cash from operations, cash proceeds from the asset sale, they'll be able to use that to chip away at the 18s. And obviously, they have capacity issue at the 1.5 lien level. So potentially, they come to market with a 1.5 lien notes and use the proceeds to pay down the 2018s or do some sort of coercive exchange using 1.5 liens. So turning to page 11, comparing the first liens for Cliffs and Fortescue. Obviously, Cliffs first lien trades wide to Fortescue. Cliffs first lien is trading at 9.2. Fortescue is at 8.3. Obviously, both bonds would track iron ore prices lower. So if your expectation is iron prices would drop from here, it might make sense to hold off and buy these bonds when iron prices are in 40s or 50s. Very different animal, all right? Cliffs is survival is going to be contingent on resolving those automatic toll contracts, whereas Fortescue is really tied to the seaborne iron ore market. From risk perspective, we think that Cliffs has more of a risk of filing than Fortescue, given that it's very binary for Cliffs, given the automatic toll contracts, whereas Fortescue, they have a low-cost position at this point in time. And with iron ore, even if it drops to 40 or 45, they'll still be free cash flow positive. But that said, we think that the first liens on the Cliffs side has a lot more asset coverage than Fortescue if they were to file. Keep in mind, Fortescue has roughly more than $7 billion of first lien debt outstanding, the $5 billion of term loans, and $2.3 billion of first lien debt, first lien secured bonds. So if they would file, this asset coverage for the first lien bonds would be more limited than the first lien for Cliffs. Now I'll hand the floor over to Chad to talk about coal.